So what I'm about to share with you is going to make a lot of bankers and loan officers angry because I'm about to expose some secrets about HELOCs that most bankers don't want you to know. And this might explain why the next time you get a HELOC, the banker or the loan officer may steer you away from the conversation of getting a HELOC, but getting instead other types of loan instead. And so here in this video, I'm gonna explain why that is and how the entire banking system is kind of messed up. And it's really not set up to benefit for the little guys like us. So let's go and start out with some obvious facts. A bank, like any other business, is designed to be profitable for its shareholders. It's a business, it's got products, it's got services, it has to make money for the bank to stay alive. That being said, just like any businesses, there are certain products and services that are more profitable over other types of services they offer. So that being said, one of the primary reasons as to why bankers and loan officers may not be, let's just say, less motivated to sell you a HELOC is because HELOCs tend to generate very little to no commission for the loan officer as well as for the banks. Well, you see, a HELOC, a home equity line of credit, is something called a non-QM product, which is non-qualifying mortgages. And I'll explain why this fact matters in just one sec. But put yourself in a loan officer's shoes. You only have 8 hours in a day, maybe 5 days in a week to work, and you only have so much time to process loan applications. Would you spend more time processing applications that generate more commissions for you, or would you generate applications that generate less of a commission for you? Now, I'm not saying the banker or the loan officer is going to outright throw your application away. They are legally required to process the application, but there's not necessarily a time limit as to when they actually have to do it, as long as it's within reasonable time frame. And we all know reasonable time frame can mean different things to different people. So obviously, if you're the loan officer or the banker processing multiple applications, you're probably going to process applications that tend to generate more of a commission or profit for the banks over the ones that necessarily don't. And ultimately, this might be the reason why when you go apply for a HELOC, and maybe you already have, you might not hear from your loan officer or the banker for days on, and you're contacting them and you feel like you're getting ghosted and not getting any responses. And one of my companies, Accelerator Banking, which we help individuals pay off their mortgage faster, we get thousands of clients that we send to banks, and this is the problem that we see all the time, is that loan officers and bankers don't get back to us, don't get back to the clients in time, and we have to keep on following up with them until we get some kind of an answer. So obviously this can be very frustrating for individuals looking to get a HELOC. So back to the original question, why doesn't the loan officer or the banker make commissions on home equity line of credit? And if they do make commissions, why it's so little compared to maybe some other loan products such as a mortgage? So remember the whole thing that I talked about, non-QM, non-qualifying mortgage? Well, most mortgages today that are being generated and backed by Fannie Mae, Freddie Mac, which is a quasi-government, it's supposed to be a private company, but basically the government has an oversight and controlling interest over Fannie Mae and Freddie Mac. Now, most mortgages, like conventional mortgages, when you go buy a home, refinance, etc., most of them have to be designed within the guidelines that Fannie and Freddie Mac created in order for the loan to be backed by the government. And why does it matter for the loan to be backed by the government? Well, if there's ever an event where the loan is foreclosed or the borrower stops paying, basically the government steps in to ensure the lender's loss when the borrower stops paying, or the default of the loan leads to a foreclosure on the borrower's property. But that's not the main reason as to why mortgages typically lead to a higher commission for the loan officer or the banker. The real reason as to why loan officers and bankers make large sums of commissions off of qualifying mortgages, it's what the banks and lenders do with your mortgage after they've originated to you, typically about a month or two later. Now, this isn't always the case, but what ends up happening about a month or two after buying your home is that your mortgage gets sold or transferred to another bank, to another servicer, and what ends up actually happening is that your mortgage, along with thousands of other mortgages across the country, becomes packaged into something called a mortgage-backed security. Now, I know I'm throwing a bunch of terminology and jargons at you, and that's not what I'm trying to do. A mortgage-backed security, or an MBS, think of it as a mega giant mortgage that is comprised of thousands of mortgages combined into one. It's basically an investment product that these large investment bankers, Wall Street type companies sell to investors like BlackRock, Vanguard, these huge companies, investment companies that essentially makes money off of these mortgage-backed securities because they're selling them to investors. So let me bring it all back together for you. Basically, you as the borrower gets a mortgage from the lender. Then after you close on your mortgage, typically about a month or two later, the lender then sells your mortgage over to another company, typically a larger bank, a large investment bank, and they package it into a mortgage-backed security along with thousands of other mortgages that were originated at similar period of time. And that mega mortgage, which we call a mortgage-backed security, then gets sold to large investment companies like BlackRock, Vanguard, State Street, you name it. So essentially, those big, large investment companies make money by selling those products to investors with management fees, etc. involved. And without those mortgage-backed securities, basically these large investment companies don't have a product to sell to their investors. So therefore, there's huge demand for mortgage-backed securities by these investment companies. Therefore, they go to these individual banks, loan officers, and bankers and create large incentives for them to generate as much mortgages as possible. So as you can see, this entire machine, this entire beast is designed so that these big, large investment companies continue to have mortgage-backed securities to sell to investors, make a lot of money, and you and your neighbors who are getting mortgages are basically feeding into the system. Hey, that kind of sounds like the plot to the movie Matrix.
You take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes.
And we all know similar things are happening to the big pharma industry. Just like how there are alternative medicine to treat illnesses and diseases using healthier and natural ingredients, but hospitals and doctors essentially choose to use synthetic engineered medication because big pharma pays big bucks for hospitals and doctors to recommend their drugs so that big pharma actually makes more money on the backs of people. So just like how big pharma basically prioritizes profit over people's health, so do these big banks that prioritize profit over the long-term wellness, financial wellness of the everyday average American homeowners. I know it's hard to believe, but there's this famous quote by Charlie Munger who says, "Show me the incentives and I'll show you the outcomes." Basically, if there's a way to make money, people will flock to it. And sadly, big banks have figured out how to make big dollars, trillions of dollars of revenue profit every single year off the backs of creating mortgages. And if you've seen some of my other videos as to why 30-year mortgages are giant traps, you'll know that this isn't necessarily a good thing for the everyday American homeowners. So then, what do? Do you just give up and quit trying to get a HELOC? Absolutely not. In my nearly 8 years of experience helping clients use HELOCs to paying off their mortgage faster, here are some of my best tips when communicating and working with lenders and loan officers when it comes to getting a home equity line of credit. Number one, be as prepared as possible when it comes to your documents. Now, there are gonna be several documents that your banks, your loan officer is going to ask you. For us here at Accelerate Banking, we give our clients a checklist for all the documents that they have to prepare. But the reason why this is so important is because if there are documents or piece of information that's missing, the loan officer or the lender may ask you for the documents and information, and they know that it's gonna take a couple of days. So what ends up happening is that they may shove your file or shove your application down, in the queue. And by the time you do submit your documentation information, you might be down in the queue and it may take a couple of days for the loan officer to even get back to you. So it's so critical and important for you to have all the documents, information, tax returns, pay stubs, all that organized in a neat fashion so that the loan officer can immediately access it and it becomes a quick processing time for you. Number two is do follow up regularly, but don't get aggressive. So what I mean by that is, yes, do follow up, do send communication, email, text messages, and ask them if the loan officer needs anything, see how the file is going, but don't be so excessive that you're literally texting them every single day. Obviously, that's gonna annoy them and that will further aggravate them, and they might not have positive feelings towards you. Although for some loan officers, that might not impact their performance, but to some it may. So don't get too crazy when it comes to follow-ups. Make sure you communicate regularly. Number three is use wide variety of communication protocols, meaning not only just text messages or phone calls or leaving a voicemail. In fact, I know a lot of loan officers that don't necessarily check their voicemail unless it's company protocol, but use text messages, use emails. And I know some companies or some banks have a client or borrower portal, which by you can send messages through those portals. So if there are systems set up like that, make sure you use those systems because they're probably trained to prioritize those communication over other forms of communication. So make sure you're aware of that as well. Number four, another great communication strategy or tactic is when you do make contact with your loan officer and you send them your documents and information, ask them or set up an appointment ahead of time. So I like to call this BAM FAM, book a meeting from a meeting. So when you're on a call with the loan officer and you submit some new information, you process information with them, ask them, hey, when can we next talk? Can I get on a calendar with you 2 weeks or 3 weeks from now so that we can discuss the ongoing outcomes of this? Okay, so this is a great strategy so that you know when the next date or time will be to talk to your loan officer about the process or progress with your loan or your HELOC. Now, it's possible that your HELOC application may go through even before that, but it's nice to have knowing that there's always a fallback or a guaranteed date or time that you're gonna have communication with your loan officer. So all that to say, if you are a client of Accelerator Banking watching this, then we got your back. We have protocols and processes to help you communicate with the banks, with you and alongside you. If you're watching this not as a client, I hope this gave you some insights and some inner knowledge and secrets as to what actually happens and why bankers and loan officers may feel less motivated to give you a HELOC. So I hope this video explains some of their behavior and the impression that you might be getting when applying for a HELOC at your local bank or an online banking company that you're trying to get a HELOC from. So if you were entertained and found value in this video, consider checking out other videos that we have about getting HELOCs, paying off your mortgage faster, and other personal finance topics. And of course, consider subscribing and liking this video and share this video with your friend or family who's getting a HELOC. So with that said, we'll see you in the next video. Take care.